$1.4 trillion. That is not a stimulus package. That is not a rounding error in the federal budget. That is the exact figure that 6 judges of the Supreme Court of the United States made disappear on February 20th, 2026, in a single ruling that shattered 2 years of American trade strategy in less time than it takes Washington to write a press release. $1.4 trillion in projected tariff revenue, gone. $160 billion already collected, potentially owed back to importers. The legal foundation of the most aggressive trade policy in modern American history, declared unconstitutional, void, and unenforceable before the stock market closed. And while Washington scrambled to find a replacement weapon, in Beijing the party leadership understood something that the mainstream financial media has not yet told you. The trade war is not paused, it is not wounded. The first major battle is over, China won. Before we break down exactly how this Supreme Court ruling is going to affect your mortgage rate, your retirement account, the value of every dollar you have saved, and the stability of the banks where you keep that money, please make sure you are subscribed to this channel and have turned on the notification bell. This story is moving fast and we are updating it daily. And comment down below, trade war or dollar war? Which battle do you think the United States is actually losing right now? For 2 years, a law called the International Emergency Economic Powers Act, known as IEEPA, was the foundation of American tariff policy. It allowed the president to declare a national emergency and use that declaration as legal authority to impose import taxes on essentially anything from essentially anywhere. At its peak, this tariff architecture covered goods from China, from the European Union, from Canada, from Mexico, from over 100 countries simultaneously. The revenue projections were extraordinary. The Congressional Budget Office calculated that these tariffs would generate $1.4 trillion for the federal government between 2026 and 2035. This was not theoretical money. It was being counted in budget projections, factored into deficit calculations, and used to justify the political cost of trade tensions. In a 6-3 ruling, 6 justices in the majority, 3 in dissent, the Supreme Court found that IEEPA does not grant the president the authority to impose broad-based global tariffs. The majority opinion, authored by Chief Justice Roberts and joined by Justices Gorsuch and Barrett, applied what is called the major questions doctrine. The principle is straightforward. When a president wants to make a decision of vast economic and political significance, Congress must have given explicit, specific authorization. The court found no such authorization in IEEPA for this kind of sweeping tariff power. The weapon was declared illegal. $1.4 trillion, vaporized by a ruling that fits in 40 pages. What they are not telling you in the mainstream financial coverage is that this ruling does not simply eliminate future tariff revenue. It is a cascading event that triggers a chain reaction in the federal budget, the bond market, the housing market, and the broader global perception of American financial credibility, all simultaneously, all moving in the same dangerous direction. To understand why, you need to understand the architecture of how the United States government actually pays its bills. The federal government is currently running an annual deficit of approximately $2 trillion. That means Washington spends $2 trillion more than it collects in taxes every single year. Every year, without exception. To bridge that gap, the Treasury Department must issue new bonds, new debt, every single week. Billions of dollars in Treasury auctions, week after week, to fund the ongoing operations of the United States government. The tariff revenue from IEEPA was supposed to be a structural support for this equation. $160 billion had already been collected and deposited into Treasury accounts by the time the ruling was handed down. That money was already spent. It was already inside the operating budget. And now, law firms representing American importers, the companies that paid those tariffs, are already building the legal case to demand refunds. This is not a future problem. This is a present fiscal emergency. The government must now borrow more money on top of already record borrowing. to cover the deficit gap that the eliminated tariff revenue leaves behind. More borrowing means more bonds issued into the market. More supply of bonds means the price of those bonds falls. And in the bond market, when the price goes down, the yield, the interest rate, goes up automatically and immediately. This is the feedback loop that every fixed income analyst has been running scenarios on since the ruling landed. More deficit forces more issuance. More issuance forces lower bond prices. Lower bond prices force higher yields. Higher yields increase the cost of servicing $36 trillion of existing federal debt. Higher debt service costs force even more borrowing. The loop accelerates. This is not a prediction. It is arithmetic. And the arithmetic of the United States federal budget has no solution that does not involve either significant pain now or catastrophic collapse later. Within hours of the ruling, the dollar index fell below 98, touching levels that reflect the market's immediate verdict. The most sophisticated financial institutions in Asia issued emergency analysis. UOB, one of the largest banks in Singapore, published a note warning that tariff shock continues to weigh on the dollar. Professional currency traders, the people who manage billions of dollars of institutional capital, opened the largest short positions against the United States dollar that markets have seen in 14 years. 14 years. The smartest money on the planet is betting against the dollar with the largest conviction trade in a generation. This is what they are not telling you on the evening news. But the administration did not accept the ruling quietly. Within hours, President Trump signed a new proclamation imposing a flat 15% tariff on all imports under Section 122 of the Trade Act of 1974. This provision allows the president to impose a temporary import surcharge of up to 15% if he certifies that a serious balance of payments deficit exists. The tariff can last for up to 150 days under this law. Legal experts at Fortune magazine and the Council on Foreign Relations immediately identified the problem. The balance of payments argument requires a specific technical condition, a deficit in the actual capital and current accounts of the balance of payments, not simply a trade gap. Multiple trade law attorneys publicly stated within 24 hours that this argument does not hold. The conditions that Section 122 requires do not currently exist in the way the administration claims. This Plan B, they said, is also likely illegal. We have now entered a phase where the executive branch is cycling through emergency legal arguments faster than the courts can rule on them. Every time one weapon is struck down, another is drawn. Each replacement is weaker than the last, more legally fragile, and more disruptive to the international trading relationships that American exports depend on. The Allies noticed. Britain had spent months negotiating what it believed was a preferential trade deal, giving it access to a lower tariff rate than most countries. Within 24 hours of the Supreme Court ruling, that arrangement was swept away by the new 15% blanket rate. An analysis in Fortune described the move as something of an insult to every ally that had negotiated in good faith. The governments of Japan, South Korea, the European Union, and Canada are all recalculating their assumptions about the reliability of American commitments. And China is not simply watching. China is winning. Xi Jinping is heading into summit negotiations with Donald Trump, having just watched the American legal system disarm the president's primary weapon. For 2 years, Beijing absorbed the pain of elevated tariffs because they understood something that Washington never fully grasped. China was playing a long game. They were not trying to win the tariff war. They were building the infrastructure for a world where the tariff war becomes irrelevant. While American trade lawyers argued about tariff schedules and exclusion lists, China was constructing alternative supply chains, signing bilateral currency swap agreements with dozens of countries, routing trade flows through Brazil and Vietnam and the ASEAN nations, and systematically reducing its exposure to the dollar-denominated financial system. The Supreme Court just handed them that victory without Beijing firing a single economic shot. But the story does not stop there, because the implications of this ruling extend far beyond trade policy. They reach into the bond market, into the housing market, and into the architecture of global dollar demand that determines the value of every dollar you own. The dollar's status as the world's reserve currency rests on three foundations: American military power as a guarantor of global order, the fiscal strength of the Treasury as issuer of the world's safest debt, and the institutional credibility of American governance. Two of those three foundations are cracking simultaneously. The fiscal foundation is under siege. The Congressional Budget Office has already projected that interest payments on the federal debt will reach $2.1 trillion per year by 2036, even before this ruling eliminated a major revenue stream. That projection now has to be revised upward. Every additional bond the Treasury must issue to replace lost tariff revenue adds to the interest burden of future years. The compound interest of compounding deficits is a mathematical accelerant that no amount of political optimism can neutralize. The institutional credibility foundation is fracturing publicly. A government that announces a major tariff regime loses it in the Supreme Court, announces an emergency replacement within hours, and then watches legal experts declare that replacement also unconstitutional. That is not the image of a stable, predictable institutional partner. Reserve managers at sovereign wealth funds and central banks around the world are running updated risk models. Those models are pricing in a higher risk premium for holding United States government debt. That rising risk premium is paid by you, directly, not in some abstract macroeconomic way, in your monthly mortgage payment, in the interest rate on your car loan, in the APR on your credit card. You are paying the political risk premium of Washington's policy chaos every single month, whether you realize it or not. The 30-year fixed mortgage rate is mathematically linked to the 10-year Treasury yield. When the yield on 10-year Treasuries rises because the government must pay more to attract buyers for its expanding debt load, mortgage rates rise with it, regardless of what the Federal Reserve chooses to do. If the loss of tariff revenue forces Treasury yields to 6%, mortgage rates will mathematically hit 9%. 9% mortgage rates on a median American home priced at over $400,000 produce a monthly payment that is functionally impossible for the median American family to service. The housing market does not slow. It seizes. The Federal Reserve is completely trapped. They cannot lower rates because inflation remains elevated and the tariff chaos threatens to reignite it. They cannot raise rates because the economy and the banking system cannot handle higher borrowing costs given the existing debt loads. They are held hostage by the bond market, and the bond market is now pricing in the full fiscal cost of a government that has lost its revenue architecture. This is what financial economists call fiscal dominance, a regime where the size of the government's debt supply matters more than the central bank's monetary policy decisions. We have entered that regime. The Supreme Court ruling just accelerated our arrival, but here's where it gets worse. There is a second front opening in this financial war, and it has been building steadily for 2 years while the public attention was fixed on tariff headlines. China did not spend the last 2 years passively absorbing tariff pain. They were building the infrastructure for a world where the dollar is optional rather than mandatory in global trade. The cross-border interbank payment system, known as CIPS, which is China's alternative to the SWIFT messaging network, is processing a growing and measurable share of global trade settlements. The mBridge platform, connecting central bank digital currencies from China, Hong Kong, Thailand, and the United Arab Emirates, has reduced transaction times from days to seconds and cut costs by 50%. Every country that opens a CIPS account reduces its dependency on the dollar system. Every bilateral currency swap agreement, and China has signed them with dozens of countries, is a transaction that bypasses American financial infrastructure entirely. The structural demand for dollars as the mandatory currency of international trade is eroding, not collapsing overnight, eroding, trade deal by trade deal, swap line by swap line, month by month. The global financial system stores approximately $6.5 trillion in dollar-denominated foreign exchange reserves. When the managers of those reserves begin to ask whether they need to hold quite so many dollars, whether the yuan, gold, or a basket of commodities might be a more stable and less politically exposed store of value, the demand for those reserves falls. When demand for dollar reserves falls, the value of every dollar falls. including the dollars in your savings account, including the dollars in your retirement account, including the dollars that represent the equity you believe you have built in your home. This is not a future risk. The process is already underway and confirmed by the central bank gold accumulation data. The People's Bank of China has purchased gold for 15 consecutive months. According to the World Gold Council, global central bank gold purchases have reached their highest sustained pace in over 50 years. Russia, India, Turkey, Poland, Kazakhstan, all accumulating at record rates simultaneously. These are the most informed financial institutions on the planet. When they collectively and consistently convert dollar reserves into gold at a 50-year record pace, this is not coincidence. It is a coordinated institutional verdict on the future value of the dollar. They are not buying gold because they enjoy owning a shiny metal. They are buying it because gold is the only reserve asset that cannot be struck down by a court ruling, cannot be frozen by a sanction, and carries no counterparty who can default. In a world of weaponized finance, gold is the only truly neutral asset. The cheap dollar is going. The foreign buyers of American debt are going. The bill is finally coming due. And now we come to the part of this story that reaches directly into your bank account. The part that the regulators are hoping you will not fully understand until it is too late. Your deposits are not sitting in a vault. They are a liability on a commercial bank's balance sheet. The bank takes your deposits and invests them, primarily in loans and in bonds. When interest rates rise, the bonds the bank purchased when rates were low are now worth significantly less than the bank paid for them. The difference between the original purchase price and the current market value is called an unrealized loss. According to data published by the Federal Deposit Insurance Corporation, the FDIC, American banks were sitting on approximately $337 billion in unrealized losses on their securities portfolios as of recent reporting periods. At the peak, this figure reached $481 billion. Silicon Valley Bank collapsed with $17 billion in unrealized losses in 2023. That collapse triggered a banking panic that required emergency government intervention. The entire American banking system is currently sitting on unrealized losses that are 20 times that size. As long as depositors do not panic, banks can hold their bonds to maturity and the losses remain unrealized. The strategy works until it stops working. And this is the mechanism by which the tariff ruling creates a direct threat to your deposits. Every additional bond the Treasury must issue to cover the deficit gap left by the IEEPA ruling pushes yields higher. When yields rise, the value of bonds held by banks falls further. The unrealized losses grow larger. As those losses grow, sophisticated depositors, corporations, institutions, wealthy individuals quietly begin moving money to larger banks or to Treasury Direct or to other assets. When money moves out of a regional bank, the bank is forced to sell some of its underwater bond portfolio to meet those withdrawals. Forced selling at a loss converts the unrealized loss into a realized one. The capital base shrinks. The regulators notice. The bank fails. This is exactly what happened to Silicon Valley Bank. It is what happened to Signature Bank and First Republic. Each one was certified as sound right up until the moment it was seized. The FDIC Insurance Fund currently holds approximately $129 billion. That fund is responsible for insuring over $10 trillion in deposits across thousands of American commercial banks. The math is straightforward: $129 billion against $10 trillion. Researchers at the National Bureau of Economic Research have calculated that if interest rates remain at current levels, a wave of commercial real estate loan defaults could trigger the failure of up to 385 regional American banks. 385. The 2008 crisis, the crisis that froze credit markets globally and cost the world economy trillions, involved 25 bank failures. We are discussing a scenario that is 15 times larger in terms of the number of institutions involved. If a chain of failures of that scale hits the FDIC Insurance Fund, the fund is exhausted. And when the fund is exhausted, the government faces a binary choice. It can borrow more money to backstop the banks, adding to a deficit that is already imploding. Or it can invoke the legal framework that most Americans have never heard of. That legal framework is the bail-in provision of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Under this framework, when a bank fails and the government's resources are insufficient to cover the losses in the conventional way, authorities have the legal power to convert uninsured bank deposits into equity shares of the failing institution. Your cash becomes stock in a bankrupt bank. Your savings balance becomes a claim on an institution that nobody wants to own. This is not a conspiracy theory. It is written into American law, and it has already been executed in practice. In 2013, the government of Cyprus froze all bank accounts in the country overnight and converted deposits above 100,000 euros into shares of insolvent banks. People who went to sleep as depositors woke up as shareholders of worthless institutions. The Cypriot government did not announce this plan weeks in advance. They announced it by locking the ATMs and closing the bank branches on a Saturday morning. By the time they admit there is a crisis, the capital controls will already be in place. The window to protect your financial position from this scenario is open today. The window will not remain open indefinitely as the fiscal trajectory, the yield environment, and the banking system fragility converge under the pressure that this Supreme Court ruling has amplified. Here is exactly what you can do right now, today, to position yourself ahead of what is coming. The first action is to immediately distribute your deposits across multiple FDIC-insured institutions, keeping your balance at each bank below $250,000. This is the limit of FDIC insurance coverage per depositor per institution. Any amount above this threshold at a single bank is uninsured and is directly exposed in a bail-in scenario. If you have more than $250,000 at one bank, open a second account at a different institution today. This is the single most important financial action available to you right now. The second action is to research your bank's commercial real estate exposure. The FDIC requires every commercial bank to report its CRE loan exposure as a percentage of total capital. Florida Atlantic University researchers have built a publicly accessible tool that lets any American citizen look up this ratio for any bank in the country. If your bank's commercial real estate loan exposure exceeds 300% of its total capital, that institution is in the highest risk category identified by the National Bureau of Economic Research. Look it up. Know your exposure before the market forces the issue. The third action is to allocate a measured portion of your savings to physical precious metals held in your direct physical possession. Not an exchange-traded fund, not a digital account, not a futures contract. Physical metal. An ETF is a claim on a financial institution. In a systemic crisis, that institution can suspend redemptions, declare force majeure, or settle your claim in depreciating cash at a price it determines. Physical metal in your possession has no counterparty. No court ruling, no bank failure, no government decree can convert it into something else. The fourth action is to eliminate or aggressively pay down variable rate debt. Credit card balances, adjustable rate mortgages, home equity lines of credit. Every signal from the bond market and from the federal borrowing trajectory points toward sustained elevated interest rates. Variable rate debt is a compounding liability in that environment. Eliminating it is the most direct way to reduce your personal exposure to the rate environment that the SCOTUS ruling has made worse. The fifth action is to consider moving a portion of your medium-term savings directly into Treasury bills through Treasury Direct, the U.S. government's public savings bond portal. Treasury securities held directly through this platform are not commercial bank deposits. They cannot be subject to a commercial bank bail-in. They are direct obligations of the federal government, which carries a different legal standing in a crisis scenario. They are not risk-free, no asset is. But they sit outside the fragile architecture of the commercial banking system. These 5 actions are not panic moves. They are the standard practice of sophisticated institutional investors in an elevated risk environment. The central banks of China, India, Russia, and Poland are already executing the institutional equivalent of Step 3 at 50-year record pace. The professional currency traders who have opened the largest short positions against the dollar in 14 years are executing their version of Step 4. The sovereign wealth funds reassessing their dollar reserve allocations are running their version of Step 2. The information asymmetry between institutional investors and the general public is real, but it is not permanent. The gap closes, and when it closes, the positions that were available at reasonable prices today will no longer be available. The Supreme Court ruling of February 20th, 2026 is a watershed moment, not because it was the single largest financial shock in American history, but because it publicly and officially exposed the fragility of the fiscal and legal foundation that American economic power rests on. The $1.4 trillion that disappeared in a day was never fully real. It was a projection built on a legal argument that 6 justices found unconstitutional. The bond market, the currency market, and the gold market all confirmed within hours that the smart money already understood this. They had already bought the gold. They had already positioned against the dollar. They had already opened the alternative payment rails. The Supreme Court ruling did not surprise the smartest money in the world. It validated what they had already priced in over the previous months. Most people watching the news today will follow the political drama. They will track the court rulings and the emergency proclamations and the legal challenges and the summit meetings. They will not be tracking the dollar index positioning, the FDIC unrealized loss data, the CIPS transaction volumes, or the central bank gold accumulation pace. They will be surprised when the consequences arrive. You now have access to the analysis that explains why those consequences are coming and what they will look like when they do. You have the information, you have the data. You have the choice to act while the window remains open. Knowledge is your armor in this fight. Preparation is your shield. And in a world of financial deception, the truth is the only asset that compounds without risk. Subscribe to this channel and turn on the notification bell so you are alerted the moment the next development in this story breaks. We will be tracking the bond yields, the FDIC data, the gold flows, the dollar index positioning, and every strategic move by Beijing and Washington as this situation evolves daily. Share this video with anyone you know who has savings in a regional bank, who carries variable rate debt, or who believes that the financial system they grew up trusting is still operating on the same rules it always has. You might save their financial future with a single share. Together, we can navigate this collapse and emerge with our wealth and our freedom intact. Stay liquid, stay skeptical, stay ahead.